Good morning or good afternoon, depending on what time it is for you. I would like to welcome each of you to our webinar series. In the email blast you received, you're presented with 4 different presentation options. I encourage you to view each one of them as they will provide you with some great insight regarding changes brought about by the CARES Act and other recent tax legislation. I only wish this was being presented at a better time for all of us. I do hope that each of you and your families are safe and healthy. My name is Ray Gallagher, and I'm a tax partner at Levine Law Firm Morrison Engelberg. This is one of 4-part presentation to help you navigate through the changes and new legislation that revolves around the CARES Act. We have divided it into 3 technical presentations and an economic overview presentation by Bob Lofgren. One final note before we get started. Keep in mind, new legislation and much additional guidance is occurring almost daily. Some of the material covered in our presentations may have been changed or clarified since we produced these webinars. We are here to help you navigate through all of this, so please feel free to reach out to your Levine Lofgren Morrison Engelberg contact for further clarification and assistance. For this webinar on business changes, we have Andy Wynn and Jeff Ewan. Andy is a tax manager with the firm. He has been practicing for the last 7 years and earned both his bachelor's and master's from San Diego State University. He currently serves on the taxation committee with the Cal CPA's Foundation and is also actively engaged within the professional community in San Diego. Just not right now. When he is not under a government stay-at-home order, he enjoys hiking, biking, and golfing. However, I am not sure of his golfing abilities. Along with Andy, you will hear from Jeff Ewan. Jeff earned his bachelor's and master's from Miami University. He spent his first 6 years working for Ernst & Young in the Cleveland office and claims to be a big LeBron James fan. He has been with LEMI for over 9 years and works with many of our high net worth clients as well as our closely held businesses. Please enjoy this presentation.
Thanks, Ray. As mentioned earlier, today we're going to go over the business tax provisions of the CARES Act. Before we get started, below are our headshots in order to help better put a face to a name. All right, let's get started with the AMT credit. With the TCJA, corporate AMT was repealed. Any remaining AMT became refundable on an incremental basis for the 2018 through 2020 tax years. For the CARES Act, the schedule was accelerated, and C corporation taxpayers can claim the credit in full in 2018 through 2020. Taxpayers with the situation can use a quick refund procedure via Form 1139 to claim the credit. This allows taxpayers to get the refund within 90 days of filing. Business interest expense limitation. For businesses subject to the interest expense limitation under Section 163J, the limitation is increased from 30% of adjusted taxable income to 50%. This is effective for 2019 and 2020. Due to the expected downturn in 2020, businesses can elect to use their 2019 ATI to calculate the limitation for the 2020 tax year. For partnerships, the 50% exclusion does not apply for the 2019 tax year. However, the following benefits are offered instead. 50% of the excess business interest expense will be treated as business expense without limitations for the tax years 2020 and onwards. The remaining 50% will be subjected to the same 163J limitation rules and put in a silo, which can be reduced over time or increase the partnership basis upon the sale or disposal of the partnership interest. This is only for 2019. For 2020, partnerships will have the same 50% ATI limitation as all other entities. Net operating losses. Previously, taxpayers can only carry forward losses and apply it against 80% of taxable income for the year. The CARES Act suspends this limitation for the 2018 through 2020 tax years. NOLs in these years can be carried back for up to 5 years. This provision applies to both corporate and non-corporate taxpayers. Classification of qualified improvement property. The Act provides a technical amendment to the treatment of qualified improvement property, also known as QIP. This is effective for all property licensed service after December 31st, 2017. QIP depreciable life has gone from 39 years to 15 years, and thus making it eligible for bonus depreciation. Taxpayers with significant QIP may want to amend their 2018 tax returns in order to claim a refund. Excise tax exemption. Distilled spirits used in the production of hand sanitizer and methods approved by the FDA are temporarily exempt from excise tax. This exemption is effective for the 2020 calendar year. Charitable contributions. The corporate charitable contribution limit has been temporarily increased from 10% of taxable income to 25% for the 2020 tax year. These contributions must be made to a public foundation or charity, and donor-advised funds do not qualify. Payroll tax changes. As a result of the various stimulus bills, there's been many changes and credits arising as a result. I'm going to discuss the employee sick leave credit and the expanded FMLA credit, while my colleague Jeff Ewad will discuss the employee retention credit and the employer payroll tax deferral. Employee sick leave credit. The Families First Coronavirus Response Act, Phase 2 of stimulus, mandates that employers with fewer than 500 employees provide paid sick and family leave for workers. To lessen the burden, several payroll tax credits were established. Employees who are unable to come in due to contracting the coronavirus or quarantine as a result are able to get full pay for 10 days up to $511 per day for a maximum of $5,110 per employee. A corresponding payroll tax credit for the same maximums was created to offset the burden. Employees who are caring for someone or on leave due to an HHS specified condition are able to get 2/3 pay for 10 days up to $200 a day for a maximum of $2,000 per employee. The corresponding payroll tax credit for the same maximums was created to offset the burden. Expanded FMLA credit. The new law also expands the existing Family and Medical Leave Act to cover leave of absence to care for a minor child due to school closure or lack of child care. Workers will receive 2/3 of their regular pay up to $200 per day and for 50 days and a maximum of $10,000 per employee. A corresponding payroll tax credit for the same maximums was created to offset the burden. This benefit does not kick in until after 2 weeks. It's presumed that the employee has taken sick leave prior to taking the FMLA leave. An additional benefit to the Act means that self-employed individuals are also eligible. Due to the nature of their compensation, rather than their wages, the person's average daily self-employed income for the year is used instead. For those sector quarantine, the daily credit is the lesser of $511 per day, or 100% of the person's average daily self-employment income for the year. For those caring for someone out with an HHS-related condition or taking FMLA leave, the daily credit is the lesser of $200 per day, or 2/3 of the person's average daily self-employment income for the year. Thank you so much. And now on to my colleague Jeff to discuss the retention credit and the payroll tax deferral.
Thanks, Andy. The CARES Act gives us one more credit beyond the family leave credit and the sick leave credit that Andy touched on, and that is the employee retention credit. It's a fully refundable payroll tax credit. So more specifically, it applies to the employer's portion of Social Security tax. And it's available to employers that have two different situations. One is that the employer was forced to fully or partially shut down by government mandate as a result of COVID-19. And as long as they are shut down for some part of the quarter, they can claim the employee retention credit for that quarter. So, for example, Governor Newsom declares shelter in place. I believe it was March 19th. That's spanned into April. That affects Q1 and Q2 at the very least for those businesses affected. The other way a business can qualify is if they experience a significant drop in gross receipts. And that's defined as gross receipts in a given quarter of 2020 are less than 50% of gross receipts for the same calendar quarter from 2019. So a simple example, gross receipts in Q1 2019 are 100,000. Gross receipts in Q1 of 2020 are 40,000. That's obviously less than 50% of last year. And therefore, the employer in that example would qualify for the retention credit. And it's applicable to wages paid between March 13th, 2020, the date the president signed the CARES Act into law, through the end of the year. The credit is calculated at 50% of qualified wages. So what are qualified wages? Well, it's determined by the number of employees in the company. So if there's over 100 employees, you count the wages for those employees who are not working. So if they're not providing services, if you're paying them to stay home, that's when you get to take the credit. If you have 100 employees or less, you can take the credit against wages paid to all employees, whether they are staying home and you're paying them or they are providing services. We should note here that related entities or affiliate groups, you need to look to the aggregate number of employees across those entities to make the determination of whether you're over 100 or under 100. The total wages that can be taken into account for a given employee is $10,000, and that's across all quarters that might be applicable, not per quarter. So $10,000 per employee. The $10,000 includes that employee's allocable share of qualified healthcare costs paid by the employer, provided that it's not taxable to the employee. It excludes any wages that have been used in calculating the family leave credit and the sick leave credit, the ones that Andy touched on in the beginning part of this presentation. So as mentioned, it's a credit against the employer's share of Social Security tax. It's applied after the family leave credit and the sick leave credits are applied. And it can be claimed now, two different ways. So one, when the employer is going to make its normal payroll deposit, payroll tax deposit that is, they can reduce the amount of that deposit by the credits claimed. You don't have to wait until the end of April when you file in the Form 941 payroll tax return for Q1. You can claim it now, right, via reduction in payroll tax deposit. Now, there are scenarios, and we'll go through an example here in a moment, where the credit exceeds the amount of payroll tax. And you can be in a refund position. As we mentioned, this is a refundable credit. In that case, you can file the newly issued Form 7200, new IRS form, that allows you to file for an advance on the credit. And those couple weeks, could make a difference for a lot of employees, or employers rather. We should note, as we are tax accountants here, we should note the income tax ramifications of claiming the employee retention credit. I mean, it's a payroll tax credit, but it will have a potential impact on your filings in 2020. So the payroll deduction that you take on your 2020 return will be reduced by the amount of the employee retention credit claimed during the year. So let's look at an example. So Lofgren's Lumber employs 5 people, and the business is instructed to shut down by order of the governor as a result of COVID-19, right? So we check that first box. So we're eligible for the credit in that quarter and any subsequent quarters that they stay shut down. The company continues to pay its employees, and after considering the wages used in calculating the family leave credit and the sick leave credit, and factoring in the employee's allocable share of employer-paid health care, the company has $20,000 of qualified wages. So we know this is a 50% credit against qualified wages. So we have a credit of $10,000 to use against the employer side of Social Security tax. So let's go through 2 different scenarios with respect to the Social Security tax liability. One, Lofgren's Lumber has $12,000 of Social Security tax liability. They have a $10,000 credit. You can reduce that $12,000 by the $10,000 credit. We have $2,000 left over. And as we're going to talk about in a moment under a different program, that amount can be deferred, right? In another scenario, let's say that there's a $8,000 tax liability. We have a $10,000 credit. So we can take that $8,000 down to 0, and then we can file our new friend, the 7200, right, Form 7200, to request a refund for the $2,000. Now, this landmark piece of legislation, or the one that everyone's talking about as part of CARES, is the Paycheck Protection Program loan. There's an interplay between the employee retention credit and the PPP loan. And as an aside, you should definitely check out our firm's other video with respect to loans under CARES. Brian Surratt does a great job of explaining all the intricacies of the PPP loan. So as mentioned, there's an interplay between the two. So if you're borrowing under PPP, you cannot claim the employee retention credit. However, you have to consider the timing here. So people are, or rather businesses are applying for the PPP loan, right? Some have submitted applications, some are in the process of doing so, and they don't know if they've received that loan yet. In the meantime, as we mentioned a moment ago, the retention credit is applicable now, right? You can claim that now. You have wages dating back to March 13th, and hopefully you're going to continue to incur those wages and be able to pay them, and you'd be eligible for the employee retention credit, provided you're under one of those scenarios that we mentioned. So claiming the retention credit does not preclude a company from applying for or securing the PPP loan. However, if they do get the loan, the PPP loan, it does appear that the employee retention credit claim to date would need to be recaptured, right? So it would need to be paid back. So in the example, this first part, the first scenario, I should say, where we have $12,000 liability, with $10,000 credit, we have $2,000 left over, right? So under normal circumstances, I guess what's normal circumstances any longer, but under normal circumstances, that $2,000 would need to be remitted, right, as a payroll tax deposit. But under the payroll tax deferral, which is another program provided to us by CARES, that does not need to be paid. And it does not need to be paid until 2021 and 2022. So you can defer payroll taxes from March 13th through December 31, 2020. And again, this is the Social Security piece of payroll taxes, employer side of Social Security. And whatever has been deferred at the end of this year is due 50% at the end of 21, 50% at the end of 22. Again, some interplay between the PPP loan and payroll tax deferral. So business cannot have a PPP loan that is forgiven if it defers the payroll taxes. So if you take advantage of the payroll tax deferral program, that impacts your ability to claim the forgivable piece of the PPP loan. You can certainly have the PPP loan, but you may just need to pay it back. So that is my piece of the presentation. I'd like to send it over to Jen Glazier, who has some closing remarks.
Thank you, Jeff. Thank you all of you for joining us today to listen to our presentation on businesses. There are some great tidbits in there that Andy and Jeff touched upon, one of which is that partnership interest that was previously limited. So if you had some business interest limitations previously, you now can take that interest on your individual level. That's usually reported on your K-1. So that was a great change with the CARES Act. Another item that we were really excited about was the qualified improvement property change. You may have not realized how big that was, but this is something we've been asking for a very long time, for them to go back and make this technical correction. So what they did was they changed the qualified improvement property, so that's your tenant improvements. They changed that from 39-year property to 15-year property. And by doing that, you're able to take bonus depreciation on that. So basically in the first year you place it in service, you're able to write it off right away. We couldn't do that last year, unfortunately, but we are looking at your returns that we filed last year, seeing what assets qualify, what things we can do, whether it's going back and amending your 18 return or looking at taking that adjustment potentially in your 19 or your 2020 return. So that was a huge thing with the CARES Act that came through for us. Another great benefit for all of you that I know all businesses are just trying to figure out how to survive right now, but those payroll tax credits, those payroll deferrals, those are great tools to use. I would caution you though, reach out to your LEMI advisor, ask them how that interacts with the other loan programs, because there's a lot of interaction between all these different loan programs and credits and deferrals. If you do one, you can't do the other. So we really strongly encourage that you reach out to us and just ask questions. So from our family to yours, thank you for tuning in. We really hope that you're staying healthy, that you're with your families, enjoying this time. I know we don't like to be cooped up at home, but hopefully everyone's taking advantage of this opportunity to be all together. And please reach out to your LEMI advisor. We're all standing by. We're here to support you, and we really appreciate your business. Thank you for joining us, and we'll talk to you soon.